So at this point, I'm going to transition into a quick sort of market update. A lot of the investors on the call are probably from out of state, and so they don't see the day-to-day or get a feel for the day-to-day. What's happening in Tampa Bay sort of is a question I get asked all the time with regards to the real estate market. I think it's best described by it is a very strong seller's market right now. Inventory is extremely low, demand is extremely high. Inventory is down roughly 50% year over year. During that same time period, prices have gone up about 15%. So on the positive side, there's lots of appreciation and equity to be gained through market increases. On the negative side, it's a tough time to find anything to buy, but that won't continue forever. We're also experiencing strong rental demand. We have lots of tenants flocking to this area. And I don't know if you can see the graphic that I put up on the screen. That's actually from our an article that I published on our Facebook page. And you can find that at Copeland Morgan or facebook.com/Copeland Morgan. But as you can see there, we have people flocking here, and the top three areas are New York, New Jersey, the DC metro area, and Chicago. And then in-state, you know, from higher priced metros like Miami, people are moving to the Tampa Bay area. And so the positive there for investors is we have lots of demand for rentals, you know, probably more people than there are houses. And that's a good situation to be in if you own real estate. The challenge there is it creates a lot of demand and puts a lot of stress on the inventory. And I think if you think about it, these are normal patterns that we've always seen here in Florida, but COVID has really sort of amplified them. You know, if you work from home now, you don't need to pay for an apartment in Manhattan, and you don't need to shovel snow in Chicago. And so those people are looking for nicer places to live in terms of weather with lower cost of living. They inevitably, you know, look to Florida. And so the landlords and the investor money is slowly following suit, in addition to people landlords fleeing the less landlord-friendly states such as California and New York. And so it's created a really interesting trend. Despite all the economic upheaval that COVID has caused, it has put some real pressure on the Florida real estate market to kind of play catch up in terms of supply and demand. And I just want to mention that I don't just make up these statistics. I share a couple of links down here at the bottom. If you want to jot these down, it's pinellasrealtor.org/stats-release. That'll give you monthly market metrics and statistics for Pinellas County. And if you want the same thing for Hillsborough County, it's tamparealtors.org/resources/market-stats. Those two links are awesome anytime you want to kind of get your feel of the pulse of the Tampa Bay real estate market. I'll leave those up for just a second if anybody is writing. Another resource I want to share, many of you are already subscribed to it, but I have to throw it up here because if any of you investors on the call are not subscribed to this, I really feel like, if I say so myself, it's some of my best work. This is a series of emails that you can sign up for. That's somewhere between a subscription and a newsletter, you know, type situation. But it really stems from frequently asked questions. You know, they were questions or topics that people ask me about all the time, every day. And so after a couple of years, I eventually got the idea to write some of this stuff down. And so as you can see there's an email that, you know, and they all have links to resources and things like that called The Lay of the Land, you know, neighborhoods and submarkets that you can target for investing. There's one about flood zones and flood insurance. There's one about hurricanes. There's one about analyzing, you know, rental properties. There's one about 1031 exchanges, seller financing. You know, they're all very specific, kind of hard-hitting topics that most real estate investors are interested in or want to learn more about. So you can find all this at the multifamilyguy.com/education. If you haven't already, I highly recommend it. And some of the stuff you can find on the site if you go over to the blog link, but some of it is also links to like outside resources and stuff that you won't just find on our site. So there is still value in the subscription, even if you've already found some of the resources on our website. A couple of other links, if anybody's looking for our property management info or rate sheet, it's at copelandmorgan.com/property-management. Another resource that I absolutely love for landlords, especially newer landlords, is a resource put out by the law firm of Heist, Weiss, and Wolk in South Florida. They call themselves the property manager's partner, and that is very much true. That's what they do. But they have a resource called Evict TV, and you can Google either one of these, Evict TV or Evict Cast, but literally videos and podcasts. If you can imagine a problem that you're having or might have someday as a landlord, chances are Harry Heist has made a video about it and told you what to do about it from an attorney's perspective. And so I highly recommend these. My philosophy is always that the more educated my clients are, the easier my job becomes. And hats off to Harry Heist for making literally hundreds of these videos. And they are all just outstanding. So I highly recommend checking that out if you're a landlord or an aspiring landlord, or you have a problem with a tenant and you don't know what to do. I bet you Harry made a video about it already. And then finally, many of us connected with each other on Bigger Pockets, but if you're not already on Bigger Pockets, you're missing out on one of the best free resources in the world for real estate investors. At this point, I'm going to open it up for Q&A. With this many people on the call, though, I'm going to ask that you stay on mute, but use the chat box to kind of just post what your question is about. And that way I can call on you one at a time to unmute yourself, answer your question, and then we'll talk about it for a couple of minutes, and then I'll ask you to go back on mute as we move on to the next question. So Mitch, you can go ahead and unmute yourself, and I'll let you go ahead and ask your question out loud, and I'll chime in, and if any of the other agents on the team have some thoughts, I'll certainly welcome their input as well.
Hey, can you hear me?
Yeah, loud and clear.
Awesome. Okay, so yeah, like I said, I currently live in San Diego. The main reason I'm looking at Tampa is because I've always really wanted to live in the South. It would be my seventh state. And the real estate market in San Diego is to the point where it's nearly to find something that cash flow positive. You know, it's an incredible market here. So my question being, what would be, in your experience, the average sale price for a fourplex in the Tampa area, in the Bay Area?
I think I can best answer that in terms of price per door. A couple of years ago, I would have told you about 100K per door. And I may have to ask you to go back on mute because I'm getting weird feedback. Okay, there we go. So, but that has definitely, you know, all the forces we talked about earlier are putting pressure on that. And I'm talking, you know, the B2C class properties where everybody wants to be. There may be stuff out there cheaper, but something that you would want to own and we would want to manage. Right now, you're probably somewhere in the ballpark of 125K per door. So, you know, for a fourplex, you know, 500K would be kind of a target, give or take. And if for any of the other team members on, I don't know if you guys are seeing anything different, but definitely north of 100K and probably 125 per door is quickly becoming the norm.
I heard you said 500K. I had some audio problems there with my headphones. I didn't catch the last few sentences.
No problem. In a nutshell, a year or two ago, I would have said 100K per door. All those market forces that we talked about earlier have definitely pushed it closer to 125 per door. So I would say for a fourplex in a B2C location, you're looking at 400 to 500K for something that you know, that's something you would want to own and we might want to manage, and you know, maybe a little bit of a value add, but it's going to be somewhere in that ballpark.
So that would be around maybe a 6 or 7 cap rate. Does that sound about right?
Again, all those elements we talked about in terms of the supply and demand have really pushed the market cap rate closer to 5. So I would be inclined to say 5 to 6 right now in this market. It is definitely, somebody described it as frothy. And I was like, that's a great word. That definitely describes it well.
Awesome. All right. Thank you.
Thank you. So Todd, you had a question about an LLC. I think your question is pretty clear, but if you want to unmute and expand or clarify, you're certainly welcome to.
Yeah, I just had a question about asset protection. I currently have a 5-unit multifamily that's just an LLC multi-member. I want to expand this year, and so I'm wondering, would you recommend to have an LLC for each property that I own, and then have kind of a overarching LLC as a holding company? Or do you have any thoughts on that?
Sure. Well, let me start by saying I'm not an attorney. I can't give you legal advice, but I can tell you what many other investors end up with in terms of answering that question. It all comes down to assets, how many assets you own and how many assets your LLC owns. If you have one property and one LLC, that is a separate entity from Todd Will as a person. So if somebody breaks their hip on your fiveplex, they can't come after you, your bank account, your vehicles, your retirement, whatever. Putting a second property in that same LLC is probably not going to increase your risk, exponentially. I'm sure you have another property, but the assets that people can come after in search of some type of damages are limited to the assets that LLC owns. So some people absolutely do compartmentalize it very much and put every property in a different LLC. The downsides to that are you got to have a separate set of books, separate tax returns for each LLC. So it's a trade-off between liability and ease or convenience. I don't think there's a huge prevalence of people breaking their legs and suing owners of rental properties. And so my personal opinion, and again, it's not a legal opinion, I don't know your situation, I don't know your assets or anything, but my personal opinion is owning 2 or 3 properties in one LLC still going to give you the asset protection, and you're still going to be limited to the assets that LLC owns in terms of liability. Now, the other thing is insurance coverage is the other way that you protect your assets and transfer that risk. And just because you have $1 million liability policy doesn't mean your insurance company will just write somebody a check for $1 million if they break their leg. Insurance companies have a duty to defend, and they're going to step in and they're going to basically fight that claim. I mean, their whole reason for existence is to not pay claims or minimize claims that they pay out. So if somebody breaks their leg and says, I'm suing you for $1 million, your insurance company is going to step in and say, no, we'll give you $100 or $50 or $5,000 or whatever, all the way up to, mediation or a courtroom if they have to. And so, especially if you have good liability insurance coverage, having a few properties in one LLC, I personally don't see that as a huge risk. But again, that's a question for your attorney and your tax professional. Forgive me if I mispronounce your name. Is it Amy or Ami?
It's Amy.
Okay. Most desired type of rentals. You mean from a demand from tenants standpoint or for real estate investors?
From the renters.
I would say all things being equal, a single family home is always preferred to a multifamily property because you're going to have things like a backyard and a little more privacy. You're not sharing walls. You don't have people above you or beside you. And in terms of, for example, unit mix, I think kind of like the 2-bedroom, 1-bath or a 2-2 is kind of the sweet spot. Once you get up into 3 and 4 bedrooms, and most of those tend to be single family homes, there's actually less rental demand in my experience because people who need 3 or 4 bedrooms may be in the stage of their life where they're looking to buy a home. There aren't as many people renting large single family homes. And frankly, there aren't as many 3 and 4 bedroom apartments, in terms of inventory anyway. I don't think there's a huge difference between, a small multifamily and an apartment complex in terms of what the tenants demand. I think they're more concerned about amenities at that point, such as square footage, type of flooring, type of kitchen, things like that. Did that answer your question?
Yeah, it did. I'm coming from the Northeast. I'm originally from New York and currently live in Jersey. And I do have several single family and multifamily properties that I rent here. Obviously trying to move south because the taxes are ridiculous up here. And I'm looking to invest in the Tampa area just because of everything you've described as far as growth and demand. And I'm looking to, move away from sort of the single family, multifamily into larger, five or greater, basically 10, 15 doors. And I'm just wondering, is there a big market for that down there?
Yeah, everything we talked about earlier pretty much still holds true. We have tons of tenants moving to this area from some of those same areas, New York, New Jersey, and other places. So there is strong rental demand, at the right market rent. And market rent is obviously kind of slowly creeping up, probably not as fast as resale prices because of COVID and some of the other, pressures that have been placed on rental rates at the moment, but the demand is there. We rarely have a vacancy that lasts more than a week or two, if it's priced right. And so, yeah, there's demand for all of it. It really becomes a question of what's available to be buy when inventory is so constrained.
That's probably what I was intending to ask, the availability rather of those types of buildings to purchase currently.
Yeah, in a really quick nutshell, it's much easier, in my opinion, in my experience, to find a single family home that would make a decent rental property in terms of finding something to buy. There's just more of them. But single family homes are not going to throw off as much cash flow as a multifamily. Single families are more of a retirement plan. They'll pay off, 20, 30 years from now when the debt is paid off. So they're not a bad investment. They're just a different investment.
Understood. Thanks.
Thank you. Laura, you're up next. I think your question is very clear, but you're welcome to unmute and chime in if you feel like you need to.
Hey, this is Frankie and Laura here, husband and wife team. We were just wondering what your predictions are for the market. We've been looking with John for a property, and we actually just moved down here, and we're just kind of finding the same things that you've already discussed, low inventory, high demand. So just wanted to know what your predictions are for this year, if you think, with any of the moratoriums lifting, if you see that prices will start to go down, or at least we have more supply on hand.
I think, and this is kind of anecdotal, I don't know that I have any specific data to back this up, but if I had to make a prediction, which I'm always loath to do because you never know what's going to happen, but I think supply will pick up a little bit. I think some of it is seasonal. The springtime is always a busier season here, even though it's not driven by the weather. I think it's driven more just by that annual cycle. You kind of survive the holidays and you start looking ahead to what you're going to do for this year. And so the spring and summer is when people buy and sell more properties on average. So yeah, I do think supply hopefully will shake loose a little bit in the coming months, but I don't think I see prices leveling off anytime soon. It's simply a matter of supply and demand and all those factors we talked about earlier with tenants moving here and investors moving here and inventories, constrained. That's just not a recipe for prices to go down. John, would you agree?
Yeah, I think so. I think the inventory, I think it's going to pick up a little bit, but with all the people moving here and all the forces that you mentioned, I think the prices are going to kind of stay up for a little bit.
Yeah, and in terms of inventory, I mean, it's down about 50% over last year, so it's certainly not going to double and go back to 2019 numbers. So I see maybe a slight uptick, some seasonal changes, but I don't think we're going to go back to 2019 anytime soon.
Awesome. Thank you.
And Doug, you had a great point. Tenants care a lot more about where is the property. That's the three most important things in real estate: location, location, location. And then probably a close second or maybe even a first is, can I afford it? And so, yeah, if it comes down to, again, all things being equal, sure, a single family home is better. But in many cases, the single family home is more expensive. And so that pushes them down into, searching for an apartment. A crash in 2022, based on everything we've talked about in the last few minutes, I mean, these are just, basic macroeconomic indicators. There's no indication that a real estate crash is coming anytime soon. what the economy will do, no one can predict, and to some degree, it doesn't really make any sense right now. But there's a lot of government stimulus out there propping up the economy, and you have to remember the housing market doesn't necessarily move in lockstep with the economy, and so the economy could take a downturn. I won't use the word crash. That doesn't mean that the housing market will follow in that downturn. Housing market is driven by supply and demand, and for a number of years now, we've had more demand than there is supply. To put it down to very, very basic principles, there are more people looking for homes than there are homes, and so that puts a lot of pressure on supply, and it drives up prices. Now, on the margins, will we see an uptick in foreclosures like Doug was mentioning earlier? Sure, there's going to be that small percentage of people that were over leveraged or had non-paying tenants that put them in a financial bind, and we may see an uptick on the fringes and some foreclosures and short sales and things like that. But I wouldn't really consider that a crash. I would almost consider it more of a return to normal levels.
Thanks.
That's the last question from Amy that I see in my chat bot. Whoop, there's somebody else. Yeah, Doug, that's a good point. And Doug, feel free to unmute and expand on that.
Now I just have to figure out how to do it.
I know there's too many buttons.
I think personally, in looking at the 2008, 2009 market crash that we had, I think the banks had better leverage to basically give a mirror test to anybody and give them a loan. Whereas since then, they really cracked down on a whole lot of criteria for the banks and the qualifications to get loans. The other thing is, I think the government has actually said, yeah, we bailed you out before, we're not doing it again. So I really don't see them I don't see the major market correction that we had back in 2008, 2009. Even with like the foreclosures and that kind of stuff, I see a lot of foreclosures going to be coming because there's too many, shall I say, idiots out there that think, oh, good, we don't have to pay our mortgage till the government says we have to pay again. But and a lot of people are going to get their butts in a sling over that. But to me, I think there will be some correction just because of the whole COVID thing. I don't think it's going to be as major that we saw back in 2008 and 9 when the housing market skyrocketed in Orlando. I was over there at that time. We had 350% higher on properties that I'm going, there's no way this is going to hold. But because they passed the mirror test, they got the loan. So a lot of upside down people back then. But I think the regulations and all are going to keep this. I find it funny how sales are just booming all over the place, and I don't see the same cautions that I did back then, just because it's going up gradually and people are pushing the market, and that's how it all works, is you push the market to try and make as much as you can. But I don't see that same type of crash, so to speak, or market correction that we did back then.
Yeah, and I think lenders are very, or I will say relatively strict right now in terms of underwriting and LTV and some of the other things that got them in trouble in 2000, in the run up to 2008. Just giving a mortgage to anybody with a pulse. They certainly don't do that anymore. I did a couple of refinances in 2020, and they ran me through the ringer. It took weeks to convince them that I was gainfully employed and could afford to pay my mortgage. And so they're cautious, even I guess cautious but optimistic at the same time in terms of real estate prices. And the loan to value is the other thing that I think protects people. If you're leveraged at 100% and you have a 10% decline, well, now you're upside down. But if you're leveraged at 70 or 80% LTV and the market takes a small dip, you're still, positive in terms of equity, and that doesn't put you in under the gun in terms of facing foreclosure.
I agree. And that a lot of that comes from the analysis. I make sure that as an investor that you're not buying a property way over market. And I've had some that I've looked at that were 150,000 over market value, and I'm like, does this make sense to you? And they're like, no, it doesn't, but because of whatever the seller's situation is, they're going, hey, the market's flying, let's just see if we can get extra money out of it. And some of them can, some of them won't, but that's where we come into play and helping analyzing the properties and making sure you're buying it right.
Good point. Are there any other questions? I guess we're kind of approaching the tail end. I'm not seeing any more questions in the chat. Amy, I see you raised your hand, but I'm not sure what to do with that.
It was easier than typing out.
Okay.
I had two separate questions. If that's okay.
Yeah, I do see a question for Jeremy. If from Jeremy, it popped up just before yours. If you don't mind, I'll jump on his first, and then we'll come back to you.
Absolutely.
So the best way or most efficient way to scale and buy as a buy and hold investor. I think one of the team members hit on it earlier, the BRRRR method. If you're able to buy value add properties, fix them up and then refinance and pull out some of that equity so you don't have all of your money tied up in deal number one, that frees up some capital for deal number two. So, it takes a little time and a little elbow grease, so to speak, but refinancing in general is a great way to scale up. And in an appreciating market with value add properties where you're able to force some equity and then refinance and recoup some of that investment, putting those funds toward the next property is certainly a great way. And really, in my opinion, the way you get there in many cases is by effective management of your rental properties. Make sure you're renting them at full market rent. In order to do that, sometimes you have to invest in, some new flooring and new kitchens and new paint, and now your rent goes up 30%. You do that times 4 on a fourplex, and now your value goes up 30% because of the cap rate. And then, you refinance at these historically low rates, and you're able to, sort of roll that equity forward into another deal. That's one way, short of, saving up money to do the next deal. I think that's where everybody struggles. We're either sitting on some cash and can't find a deal to buy, or you find something and all your money's tied up, and then it feels like you watch all these deals pass you by when you don't have the cash ready to go. So you're not alone in that challenge, Jeremy. That's a tricky one that all investors face.
Thank you, Jeff.
Did I answer your question, or did you want to expand or clarify anything?
No, I mean, that hit on the head. I think, well, first of all, I just want to say thank you, Jeff and team. I'm relatively new to the whole real estate game. Moved here from New York. So again, just thank you for all the knowledge. And I really do appreciate this forum to learn. No, again, it's just trying to get my bearings on like, how can I expand in the best way that makes the most sense for me, being new. And like you said, I am kind of just sitting and waiting, and I do want to take action, but also want to make sure I'm doing it in the most productive way.
Absolutely. It's a great question, and you're not alone in those struggles. So back to you, Amy.
Okay. I apologize because this question may be specific to me, but
that's okay.
I watched your lay of the land video, and that was really good, by the way. Thank you for doing that. It kind of did give me a lay of the land within the Tampa, St. Petersburg area. I've been to Clearwater on vacation, but I wasn't clear of all the different, areas within the Tampa Bay region. So as a first-time investor in that region, is there a specific area that you would say you should hone into versus just looking in all of the different spots that you outlined in the video that are good for investors?
My thoughts on that, if you don't live here, it probably doesn't matter as much. And the other, or the same side of that coin, is when inventory is so constrained like it is right now, I think it helps to cast a wider net not be as focused on one area, because if there's a great deal and the numbers make sense, you know, in the next neighborhood over, you know, why not take a look at that property? Now, don't get me wrong. I am a big fan of dial in what you're looking for. You know, don't come to us and say, oh, I'll buy anything as long as it's a good deal. That's really hard for us to help you, you know, craft your search to find the perfect property. But at the same time, from a geographic standpoint, I right now especially encourage people, don't limit yourself too much. See what pops up. There's not that much inventory to begin with, so don't, you know, cross out certain areas of town. You know, if a deal pops up and the numbers make sense and it's in a good area, and the, you know, the market rent and the cap rate and the gains are there, that's as good as it gets right now. So I would say don't limit yourself, but at the same time, you know, I certainly understand people who want to invest in a particular city or you know, have other reasons for it. But if you're just investing from out of state and looking, you know, to establish a foothold in Florida, to a large extent, I would say don't limit yourself. The only other thing I would add to that is, as a property manager, we certainly have kind of, you know, a 45-minute radius from our office where we can effectively manage a property for you. In many cases, we can help you buy something further afield, but we may have to refer you to somebody else for management.
Gotcha. Thanks. Is there one region more than the other that has like the larger buildings, or are they all spread out throughout the entire region that you discussed on your video?
By larger buildings, you mean apartment complexes?
Yeah, apartment complexes, basically.
No, I don't think there's a grouping of them per se. I mean, there may be parts of Tampa where there are more apartments. There may be parts of Pinellas County, you know, St. Pete, Clearwater, where there are, you know, more apartments in one neighborhood than the other. But from a very general standpoint, I can't say, well, there's more apartment buildings in Tampa or Clearwater or St. Pete. They're spread out somewhat evenly, I would say.
Okay. And the other question I had is, I noticed just in my very basic search of the property types that I'm interested in, it seems that a lot of properties are like sort of lumped in together as packages. I'm seeing like some single families thrown in with multifamilies with like maybe a small quadplex, and you know, is that typical, or is that just what's happening now because people are buying?
I wouldn't say it's typical. I think I have seen a few sort of package deals, especially of single family homes. You sometimes see, you know, it's 7 single family homes or you know, 13 condos in one community. It's not the norm, but you know, seeing 1 or 2 of those at any given time is also not that unusual. The only other thoughts I have on that is sometimes you have to be cautious of zoning. You know, if it's multiple properties on one parcel or on adjacent parcels, you want to make sure they're conforming to zoning, or the use is grandfathered in, and they're not exceeding, you know, the density requirements of the municipality and stuff like that. But yeah, that's a very property specific type of analysis that we don't need to get in here on this call.
Okay, thank you.
Thank you.